All right, guys. So for those that will be watching this on recording at some point in the future, it's March 17th, 2015, and we're a day in front of the FOMC two-day meeting. Tomorrow they released their statement at 1 Central. One thing that's important when you kind of prepare for a big event, and that tomorrow's going to be a pretty big event. Usually they are decent-sized events. Tomorrow has a chance to be a real big event, because it could be pivotal. There could be that expectation for the word patients to be removed, and yet they might leave it in there. So what's important when you prepare, though, for a big event or a big number like the unemployment report is not to prepare too many days in advance, unless you're a long-term trader and you're putting on positions based on that, that statement. So you got to average in. That's different. But when you trade like most of us do, and you prepare too early on, too much could change, right? And you're kind of wasting your time. So kind of to put it in perspective, when the unemployment report came out, we didn't talk anything about the report until the Thursday early afternoon before the Friday release. And it was a company meeting, and so our analysts would talk for, I don't know, 20, 30 minutes, if that, and then we'd roll that into other company stuff. And then Friday, we took the wire home, and Friday morning, I'd get in a little earlier and just read through it, So I didn't prepare for something weeks out, days out. So the same thing with this meeting, where you want to have give the market a chance to see what it's doing and going to do ahead of the meeting, all the position squaring and everything else. So we had a big update yesterday. It's kind of taking a pause. It was good market action today. Kind of a good two-sided trade. Those in the room probably felt that or got that. And it's probably fair to say tomorrow morning, late morning, is when I'll read most of what I'm trying to look for in the statement. So there's two key things with the FOMC statement. It's what they should say or expected to say, and then what are the outliers? What would be the surprise? And that's when you get your biggest moves and opportunity, especially if you're prepared for it. So what they should do, what's priced in, that's why you kind of want to wait till close to release time. How is the market priced in this expectation? So the bond market is going to sell off, or let's say price in a hawkish statement, and it's not hawkish, then they'll jump, right? Because they priced in a hawkish kind of statement where and hawkish, for those that don't know, is a tone that takes on higher interest rates. Well, if that isn't a hawkish release and it's some dovish rhetoric, then the market got it wrong. Doesn't like to get things wrong, it readjusts. It's the outlier. It's like the big miss in the economic number. I have on the calendar, it's maybe a month or two out, to do just one of these sessions on economic numbers and events. What's important to watch for, how to understand reaction after a number, and prepare yourself for the numbers. What's important, what's not important, what numbers are big, which ones are irrelevant. I was listening to a guy that was doing a video, and he goes over the numbers for tomorrow or the week, and he's saying numbers that are absolutely irrelevant. It's just a waste of time to look at certain events or numbers that you waste your time trying to understand what they don't mean anything. They're not going to influence the market. So as a trader, we don't care about it. And that is what we'll do for that session, how that session rolls down. So just knee-jerk, and I'll create some more previews tomorrow in the room as we get more information. There's a good chance they remove the word patients, right? So that's kind of what's getting priced in and already priced in. If they don't, that's when I think we can get some big reaction. If they leave it in, that's a dovish response or a dovish kind of statement, whereas they would probably love that in stocks because it could, price in later than sooner Fed rate rise. And that's what they're calling it, rate rise. That's what the Fed's phrase is for their rate increases to start. So if they leave it in, then it's pushed to later 2015. They take it out, you probably get a reaction, depending on how the market's trading going into it, you could get a reaction lower, but that's less of a surprise. They take it out. The fact that this is the statement with the press conference attached to it a half hour later usually is when they want to make policy changes, or not changes, but changes to the statement. So then the chairwoman, Janet Yellen, could come on and rationalize it or expand on it, right? So that this meeting does have the press conference attached to it. So you have to pay attention to the 1 o'clock Central release time and the 1:30 press conference subsequent to that, where she reads a comment and then opens into a Q&A session. So generally speaking, Bob's asking, dovish up, hawkish down. Yes. Dovish is, hey, we're going to leave rates low, or lower rates if you're able to. Stocks like that. More money, money's cheaper, money's more available. It's a central bank underpinning the economy. Stocks rally on that. If it's hawkish, that means they have to raise rates because there's too many dollars chasing too few goods and services, and that's the definition of inflation. There's too many dollars out there. Prices run up too much. In an effort to combat inflation, you raise rates, make money a little bit more expensive, less people borrow it, then there's less out in the supply. Now, I'm not an economist, but we know that as traders. That's the extent of the knowledge you need to have as traders. So I'm spending a little bit more time in this meeting because we have this Fed statement tomorrow. Those that are listening to this on a recording, it may or may not be relevant, but it is important to understand how to prepare for these bigger events. In a prop firm, we had 2 company meetings, the Thursday before the unemployment Friday, and then we would have one on Wednesday late morning on 11/12, about an hour before the Fed. The Fed used to release around 1:15, 1:17. It's a crazy release time. It wasn't exactly at a time. It's around 1:15. So we would have our meeting around noon on Fed Day that they were going to release a statement. Back in the day, not all meetings were 2-day meetings. When the financial crisis hit, every meeting became a 2-day meeting from like late 07, 08, and they've remained 2-day meetings. Back in the day, some of them were just 1-day meetings, and Tuesday, today, they'd release. So whatever the release day was, we would meet around noon. The guy that would lead the meeting, spearhead the meeting, was our analyst/trader, and he would just walk through what markets were doing, how they were pricing in, what was an outlier. And it was interesting that the owner of the company jumped in on one of the meetings. He said, listen, these are some of our worst days and some of our best days trading this report. He says the worst days is when there is not an outlier and the markets are volatile, but they become volatile and they confuse you to equate volatility with opportunity. He says, but they become really choppy and volatile. And because you're all built up with an expectation to trade a move and big moves, and you get it, but it's not that follow through, it's our worst days as a company. However, it's our best day as a company when we get the outlier. So if we don't get it, keep that in mind, and if it's something that's pretty much in line with expectations, which you'll know when you prepare, don't overtrade. Don't, temper your expectations. That's important going forward. When that was said, it really helped the overtrading aspect because you're all ready to go. You're looking for a 30-point move in the S&P and 2-3 full point moves in the bonds. If you trade bonds, those are very opportunistic moves, and you're all ready for it. And then you don't really get that outlier to just buy it or just sell it, but yet it's moving, and you're like, all right, now I'll go with it and sell it. Oh no, it's not. It rallies back 5 handles, and it really could trap you, and then you start trading from in the hole, and it could get worse, and became some of the worst days for our company as a whole because our expectations were not met, and neither was, the Fed expectations were met, but ours weren't. So keep that in mind as you trade volatility better, because that's, as you trade better, you're going to want moves like that. You're going to want volatility instances to happen every day if we could. I'd love to have September, October 2008 every day. Those are some of the busiest markets ever. August, September 2011. All right, so not to get too much into that preview, I laid out the calendar next week. Woj, Treasury Spreader, came in a few weeks ago, is going to reappear next week. George, Delta Bar is tentatively on the schedule for 2 weeks from today. This is another exercise that we did 2 weeks ago, and it's expanding on what else to look for in the dome. And that's why we got a guy leaning on a wall. It's not just to identify a lean when it comes in, but how could that create an opportunity? What am I looking for? Like we said 2 weeks ago, if you don't know what you're looking for, you won't find it. You won't anticipate it. If I'm driving down the street and I'm anticipating seeing a guy dressed in black and it's dark out and I see it, I have a chance. I'm anticipating it. I might miss him, but at least I'm looking for him. But if I'm driving down the street and I have no idea of what to look for, I'm going to miss that guy. I'm going to drive by him. And he could be the guy that gives me a clue as to what's going to happen next. It could be the enemy. So if I'm looking for him, I'm prepared, I have a better chance of seeing it. That's what these videos are about. It's not the same video. There's a collection of them. You need to go and replay them. That's why I'll post them up into Track 3 under the bonus archive videos. It goes back to what I had said to you guys in the very first meeting, or maybe it was the second meeting when I released the quoting exercise, and a lot of you guys responded to it, that I have to beg you guys to look at this and do it. But if you worked for me, I wouldn't have to beg you, because I'd just fire you. I'd just say, you're not doing it? No big deal. You're not going to come and work. No guy would never not do in these meetings, and I hosted a couple in a prop firm as a senior trader. They would never not come, ever. They just wouldn't. One guy got fired because he missed one meeting. He didn't get fired for that, but the next day he came in and he was sleeping at his machine, and the owner told the risk manager, get him out of here. And didn't fire him because he missed a meeting, fired him because he missed a meeting, and then he's falling asleep in front of his workstation. So he's not taking it serious. Why would he let the guy risk his money? So you have to, there's got to be some priorities that you create and watch them. What's interesting is what you guys said to me 2 weeks ago is you were able to see these instances immediately. That is exciting. Trying to create the ability to see stuff and not realize it. That's where skill comes in. When you're able to drive 200 miles an hour around a track without realizing what you're doing, that's a skill. I bring that up because a trader friend of mine had bought one of the sportier BMW cars, and one of the perks of buying that car was he was able to drive at one of the racetracks with one of the racing shows that came to town, or races that came to town, one of the smaller tracks we have in Chicago. He says it's unbelievable how hard it is to do 90 around these turns, and these guys are doing 200 and not batting an eye, because then he'd be a passenger with a professional driver. Well, these guys are reacting diligently to what they know, and that's the definition of skill. So putting these tapes together allows you to see the repetition and then react to it, so you're not like, all right, I'm supposed to look for this, and it's not all built up. It just becomes effortless. So here's the image, and let's get to this Prezi, and then I'll jump in the YouTube videos. We'll go over a few of them, and then I'll post the same ones we go over into Track 3 along with the recording of this video. But you'll also get, and remember this, you'll also get my George and I's voiceover that you won't hear with this. So we're talking over real time what we see. So there's added content than just what I'm going to say over it today. So there's an advantage to replaying it again and again. And so today is the lean. We went over 2 weeks ago when big buyers come in, and I had the instances laid out. In fact, let me do this here. I'm going to stop the recording. I want to show you guys something. Hold on a second. Where did I do this at? I had these instances laid out. Oh, here we go. So let me re-show the screen. So today we're not doing the big bids and offers coming in. That's what we did 2 weeks ago. The next instant that we're going to do is this one down here. A resting bid or offer. What does it mean in a lean fashion? All right. Let me go back here. Get back to our original screen. Here we go. All right. So I did this. Let me replay the screen. So I did this in a live event that we had a couple years ago in the session. I think, Carl, was it the one you were at? So Jim, it was the second one. Jim, you were there. I don't know if Jim's with us today. And we also had another prop guy who owned a prop firm that was contributing to that weekend session, that live session we did. It was a live weekend event. And he was a guy from the floor, and then also he owned a prop firm and was a risk manager and part owner of one. And I had explained why the market will go to the orders. Early on in my career, this guy Danny Scheck was his name, and he was a currency trader, and then he came in and started around the same time I did. And Danny said the market always goes to the order, always goes to the orders. He says it always went to the orders in the pit, and it always fills them eventually, and it will on the screen. Didn't elaborate much after that. So you could think of it as a magnet. So in this live event we had a couple years ago, I walked through and explained it. It was a little easier because it was physical, and I was able to walk back and forth with someone. And the guy that was contributing to the event said that's the best way I've ever heard it explained. So it forced me to explain it that way, or got me to explain it that way time and time again. So let's just talk about this black line here is a wall. And you got traders leaning on it like this guy is. Now that's just one guy, right? And now let me click on the screen. If you add a few traders, what's going to happen at some point? At some point, the wall is going to fall. And all these guys are going to be at the bottom of it, right? They're going to fall. So you've got to think of this black wall as a big order. All right, let's take this back. It's a big order, and it's a big bid, because the first video we show, I think, is going to be a big resting bid. So this black line is a big bid in the dome on the price ladder. And I don't know about you, but if I'm long and I see a big buy order, I'm thinking, man, if that goes, I'm toast. I'm going to lean on this thing. If it goes, I go. Because what do you need to get out of a long position? You need buyers. Well, there he is. I'm going to lean on that buyer. He's going to give me the buy orders to sell into. So that cadence has to make sense to you. He's going to give me the buy orders to sell into. And that's what you do to cover a long. So when this big order goes, all the longs who are leaning on that big order are going to do what? They're either going to sell it into them, or they're going to try to sell it into them. To try to sell it into them is the most important element of trading. It's not those who get filled, it's those who don't. Remember the housing example? It's not the guy who bought the house, it was the 3 bidding on it, and the 2 that didn't get it were very influential in price direction, weren't they? Same thing in the market. It's not who gets it, it's who doesn't but still needs it. They still need it. And that's what makes a market zip lower or higher when a lean gets taken out. So physically look at it. That's why I put this picture together. And if there isn't a lot of guys leaning, it won't follow through. But if there's a lot of longs, and all these images of traders are, you could think of long positions. At some point, they're the reason why the wall falls down. There's too many of them long, and they're selling it little by little. Sell it, and then wham, it's gone. And all of them that sold it were like, well, I had to get out, and I used it to get out. Those who didn't are laying on the ground trying to sell it, and that's where the follow-through comes. Let me go back over that again. And I'll try to explain it like I did in this live event because it resonated with everyone, especially with a guy who knew it like the back of his hand and was like, man, that's the best way I've ever heard it described. First of all, like I said earlier, the market and the price always goes to the orders. Well, why is that? Right? That should be a question you have. Why? Well, I'll tell you why. When you get a market that shows itself as a big buy order. Remember, this long black line is representing a big resting bid, which is a lot of buy orders, right? Let's say there's 1,500, which is a big order in the S&P. Let's say it's 30 in crude oil. It's a big oil. It's a big order in crude. So this black line is a big bid, right? Well, when the market, let me pull my pen out. Let's use blue. So when the market, if this line was horizontal, you have a better visual. But when the market's whistling down and just going, moving around like markets do, and then all of a sudden, wham, it sees, and I'm going to do it with a couple eyeballs, it sees this big order. So when the market sees the big order, and guys who know what they're doing, something happens. We start to buy it if you're bullish. You start to buy it if you're short. You want to cover. You recognize a big buyer. I want to buy it when I see a big order down there. Or I certainly want to buy it if I'm bullish and I see this and I go, now I found my buyer to lean on. So I get long and others get long. When you see this, you get long. So when that happens, the market has people who buy it or try to buy it, and it does what? It walks back up. Remember, though, it created a lot of longs in here. And when you have a lot of longs, everybody in this session knows you have a lot of sellers. And they got long because they seen a big bid. And if the market starts walking back to that big bid, it's going to be a self-fulfilling prophecy, and they're going to sell it back to where they got in for the reason they got in because of that big order. So if it's the reason why a lot of positions were opened up in front of it, it's going to be a reason why it keeps going back to it. Remember the whole concept of if this blue circle here, the bigger it is, the more long positions there are there, the much better chance it's coming back down there. If the market is here and there's a lot of open long positions from this price down here, this market's coming back down there because everybody sells back down to where they got in. Just think about it. If I'm long from here and I didn't cover up in this square and the market goes down, I'm a seller, and when it gets down to my price, I'm like, the hell with it. I'm out. I'll take a scratch. I don't want a nice winner to turn into a loser. So it's the selling back down to an open area of long positions that makes it a magnet, right? So if there were a lot of open long position, let's erase some of this. forget about this black line here. Let's create it right in here. If that's the big resting bid, and because of that big resting bid, it created a scenario where a lot of people got long right there, then it creates a magnet back down to it. It rallies the market and it has a lot of long positions. It comes back down and people say, well, I'll try to buy it maybe again and lean on it, walks it back up. And at some point, everybody who bought it there are going to sell into that big order, and that's why he got filled. He created longs right above him, which created the selling to keep bringing it back to him. Now, in the live event that we had, I physically was able to walk to the big order and back and the back, and walking back to the big order was walking back to where a bunch of long positions were opened up. I kind of articulate this in one of the lessons in the recorded edge, right? Not the group coaching ones, but one of the recorded videos with those circles and everything. Kind of walks through this. But when you add a big order as the reason why you're getting a lot of open long positions, creates the reason why that order eventually is going to be a magnet and get taken out. We're going to see it now, not just with the chart pattern, but with the market action in the book on a recording. So this big blue ball here, let's get rid of it, is all these guys, long. When the market goes up, these guys are happy, but they're not out yet. They're sellers. They're not out. And if it starts coming back, it's like a self-fulfilling prophecy. They're the reason why it comes back. That has to make sense to you. A lot of open long positions, and that's why you're what Tom calls your unconscious competence. What I had described earlier, he says the phrase for that is your unconscious competence, being able to do something without recognizing that you've absorbed the data and now you're just spitting it out into diligent reaction. Your ability to read a market hinges on your ability to identify where the hell the open positions are. And a straight profile never gives you that. There's too much room for error in that definition of an auction market theory. That's why you got to get on the ground. Where are those guys at? And it'll create better locations for whatever your time frame is. Where are these short-term guys doing? Because we're the tail that sometimes wags the head or the dog. And if you don't want to be the tail, fine, but you got to understand it because it has some influence and ability to create better locations and trading skills for you. It'll create your ability to polish your predictive skills. Hopefully this makes sense, like you could explain it to someone, because you don't know it until you could kind of explain it to a lay person, you know. Not that they have to somewhat care. You never explain something to someone that really don't care, you're wasting your time. If you're good at that, you'll be a better conversationalist. If you're talking about something that people don't care about, talk about it, they like you more. Like Carl is not good at that yet. He talks and talks, and nobody cares about what he's saying, but he keeps talking. He's getting better, but he still does it. Let me answer this question in a few moments, Jack, but it's a good one. Resting orders can be pulled. How do you protect from this? Let me answer that later, Jack. This is a great question. Could you remind me to answer this later? Don't forget it. It's a good question. So again, what we're trying to see and what we will see is, in a sense, Jack, this order getting pulled. If it gets pulled, it could have the same effect as it getting filled, okay? We'll kind of elaborate on that as we go through. What we're going to see, if I were to draw these images, is we're going to see this. And how do we take advantage of it? Remember, in this image, this analogy would be the big bid going down. So I don't know about you guys, but when a big bid goes down, I want to be short. I certainly don't want to be long. And if I'm bearish, I'm probably going to get short, and sometimes I miss it. And I miss trades. I'm human. In fact, one of these videos is a trade I missed. You'll be able to hear that when you listen back after I post it. Good point, Tom, and I'll repeat that in a moment. All right, so let's not take a break, but give me a second to bring up this video. I'm going to stop the recording so it kind of makes it a little bit more seamless. Just don't remind me. Do that. Okay. Are you guys able to see this? All right, let me keep, every time I do that it goes. All right, you're able to see it through the big screen, I imagine. Okay, sounds good. All right, I got a question to ask, and that is, if you had one chance to get the question right, look at this dome and I'll give you 5 seconds. Tell me something of information on this dome. Like I'm your customer. Give me information. One piece of information you could give me. What is it? All right, everybody's answering, and I know it takes time to type it in. The big bid at 44 even. That's a skill, believe it or not, that most traders that you're competing against, the retail audience, does not have. So don't take that for granted, that recognition of that. It's the beginning of understanding and reading a dome and order flow, but don't take that for granted, especially when you're recognizing it in real time, okay? Let's look at a couple things, though, going into it. And what's cool is having the chart next to the dome here, okay? Let me show you some things. Well, it's going to keep going back like that. All right, I'm going to stop it. You're going to have to follow my cursor here. Right in here, this market tested. This is a 6PNF, okay? You guys see my cursor right in here? Yes or no? Good. All right. So my cursor on the left came down and tested this area. It was like the third test. It walks up, follow my cursor, and comes back down. This time was like the third test to this area. So we've got additional information than just a big bid at 44 even. So you could add when your customer asks you, what else? Well, it's the third time down here, sir. Really? It's the third time down these 44 evens? Yeah. And it's a quick rotation. If you look at my cursor on a 4PNF, it just rotated off of 44 3/4 and now it's walking back down there. So you mean to tell me that that big bid has been there the whole time? Yeah. And this is the third kind of test down here? Yeah. All right. Sell it. Or don't buy it. I don't want to buy it here. Let's wait for a move lower. This is a lean falling over. Let's play it. I just say, and I stopped it a second. I just said, and you guys will be able to hear this on the voiceover when you watch it after I post it. I feel like my heels are on the cliff if I was long. I'm going to play it again. $44 are bid, and if you're quoting, it's 44 quarter bid, 100, 240 at 44 half, quarter half, quarter half, quarter half, 100 by 200. Bam. And I missed it, and I say this in the voiceover. This happened so quick that the longs were really dead because they had no chance to sell it. This was a real skip. Let me rewind it to here. This was a real skip. So now you see it. Now you see it, 1,300. Now you don't. It goes from 44 even bid 1,300 to 43.75 offer. And then let's play it. And I'm mad. You'll hear my voiceover that I missed it. And look at it. It goes. Let me play. It goes quickly. 75 offer, 43 half offer, 43 quarter one offer, 43 evens traded. And if we continue to play this thing, it's gone. All right. Let's bring in the next video. The market, I think, went all the way down in that instance to like 41. 3 tests, big bid, recognition of a big bid, context over the big bid gives you a sense of now you know how to read what you're seeing. Let's go to another video. All right. Let this clear up. All right, what do we see here? If you had a customer say, Carl, what's going on right now in the book? Give me one price below the market that sticks out to you, Carl. Carl still, he must be shagging the flies. All right, so he's got it. The big bid we're looking for is at 57 quarter, where my cursor is. Not that big, but there's 1,000 there. All right. Second thing is give me context. And if you look at the chart, look at the 4 P&F chop and look at my cursor in here. Look at the lows down here. The lows keep coming in where? At 57 even. So it's that cracked ice. You know how I say in the trading room, it's like cracked ice? You know how I predict that there's sell stops below? Well, this is the way I'm doing that. I tell the story to myself, which I want to add that word story because I want to give you guys a really kind of easier way. So remind me to build out a scenario using the right language. But look at this context. So I'm thinking, I don't know if I want to get short, but I can guarantee you I'm not getting long when 57 quarters are trading. So let's play it. And here, I stopped it again. I feel like a radio guy that is playing a tape and we're going over it. But the 57 quarters start trading right now as I stopped it. But the reason why I stopped it is in the voiceover that you'll hear when you replay this, I'm saying that, right? I'm saying all I do in the room and in these clip sessions is think out loud. So let's play it again. There, it goes, and they offer a few hundred behind it. If you want to trade a breakout, this is your shot at the title. This is where you hit it. If you don't want to trade a breakout for the sake of a breakout, but you are bearish and you're looking to execute a short, this is your trigger. So even though you're not trading momentum, you're using it to execute your bias. Because remember, the definition of a good trade location is the market going your way ASAP. Let's play it. got to have context, and there goes the rest of it. It's gone. It's absolutely gone and follows through pretty easily for 4 ticks, and then it keeps going. I'm going to keep letting it play out. Here, Brad asks a good question. How do I know for certain that the large bid is not going to hold its support? First of all, bad word. You never know for certain, just like the word exactly. I don't want to hear the words exactly or for certain. But context, he answers his own question. He says, is it context? And yes. How many times did it hold as support? The fallacy in this business is the more it holds, the more it's going to hold. BS. The more it holds, the less likely it's going to hold, period. The more you stomp on cracked ice, the better chance you have of going through it. The more you try to run through a door, the better chance the hinges are loosening up and it's going to fly open. Think of that as support holding, support holding. That's why people get themselves in trouble. Oh, wow, look at that great support. Too late. It was already great support. It already worked. It already worked. You know, the people who made a lot of money on Apple stock, they didn't, it wasn't like, well, it went from $50 to $300 a share. Wow, if it ever gets back to 50, I'm going to buy it again. Well, number one, it'll probably never get back to 50, and if it does, it already worked. It's the early bird. You got to understand the context. The more it works, the less it's going to work. Opposite of what most people think, just like the successes of this business. Now, as we move down, okay, we're what do we see in the bids? Don't look above the market. In the market below, what do we see? We see some stacked bids, right? Starting at 55.5. So if you're my customer and I'm quoting you the market, I'm saying, hey, John, the market right now just went through some support, elected some sell stops through 57.25, and it seems there'll be a lot of buying down here at 55.5. Let me play it out and allow my voiceover. I got to listen to my voiceover because I'll give myself context of what's happening, what happened before. So, well, let me just keep playing it. I'm listening to myself talk on the voiceover. So, I mean, I got to stop it, because isn't this cool if you look at my cursor, how it goes down? It doesn't show the red, red, red like it does a lot of times with sell stops, but isn't it cool how you see it, and also we're able to tie the dome in with the chart? Let me keep playing it. And oh, by the way, I stopped it again. Look at the filter over here where my cursor is. Someone lifts 57.5 on the way down, and the guy couldn't even get it to go bid. You'll be able to kind of recognize that without even, you know, as you get better, a big bid comes in and you see it and you're like, oh, they're dead. And you just tie all that together. Well, let's keep playing it. Now I see a bunch of big bids starting at 55.5. I say it on the voiceover, and you'll hear it when you guys replay it. Just play this through. The market's kind of churning. There's still a couple more, minute and a half left on this video that was clipped out. It's coming back to where it started. And I say it's either a head fake or they're going to stop. They're going to go back to where the stop started. So it's like this, let's see what the heck's going to happen moment. If you're still terribly bearish, it's giving you a chance to get back in at those 57.25. If you're bearish for another reason, it's still a place to take a shot. And I really don't feel you get killed if you're wrong. See the rotation? We go down, down bar, and it walks back up to these 57 quarters. Now what is it doing? It's rotating down. You can see the dome shrinking down, and it's coming back down to test the low of the move, which is right here, 56. Big back-to-back bids, I say in the voiceover, 55 half, 55 quarter. Just keep letting it play out. I got something I want to tell you. Just keep watching. It just got centered. That's all it is. It just got centered, 55 half. The dome just got centered. The market didn't jump. The market knows he's there is what I'm saying. Just keep watching this. Couple things. The word context. So not every big bid is the same. There's always going to be it might look the same. There's something different. The context of this one's a bit different because we just slipped through consolidation and it's coiling. The word coiling is a good word because what happens when it stops coiling, it usually just breaks out. So I would be careful trying to buy this thing ahead of this 55 half, leaning on this long based on it breaking out from 57 quarter. Make sense? And I wouldn't mind buying it to cover a short from 57 quarter. But to get long, I got to lean on them and I got to say, if I do it, I got to get out with them. If it goes, it's going to go. Just like the image I showed earlier. Let's play it again. And I'm saying in the voiceover, there. I'm saying in the voiceover, there's longs leaning on this bid, and you could see this without the skip like we had from those 44s on the previous video. Let me go back a couple beats here. Right there, how many are on the bid? 1491, right? They're hitting them. And they hit them all, and you could see in the footprint, all of them trade. That's on the left side of the X. Look where my cursor is, over 1,300. So there's only $1.70 left. Watch when they take out the 170. What happens? They hit them for 500. So not only do they trade through the 55 halves, but they offer 500 right away behind them. So there's only 80 left. As soon as they're done selling it, all of a sudden, if someone were to scream, they would say, but I need to sell more. Too bad. Nobody wants to buy it. It's your problem. Therefore, the next bid, which is 55 quarter, it goes sellers or offer. 55 evens go sellers or offer. 54.75s go offer. 54.75s. And then the video is over. I think in this, continued to move down. And I said to, and the voiceover is, late longs and desperate longs who didn't get out when the 57 quarters were taken out are leaning on this guy. When it goes, the next 4 ticks are easy, and they are easy just based on all that logic. Also what you see is, as the bids turn offer, right, as this top bid turns offer, I want you to watch the numbers in the bids below. They start to get pulled, which brings me to Jack's question. So they sell through the 55 halves as you're watching it. They offer 500 now at 55 half. And all these bids thin out a little bit. If I take it back in here, all of them, oh, there's 1,100 here, there's 8 here, there's 800 here. And then all of a sudden, when we get through 55 half, all those big shots start to pull them, and they're not as big. Boom. Look at how these 3 prices, size-wise, the quantity shrunk. And the story behind that is, yeah, it's easy to be a big shot when you're in the back, right? But get up on stage. And when a market or price comes to your price, now you're on stage. What do you want to do here? And that's where another tell could happen. This is more advanced because you're now watching a few things. Some of you might think, wow, this is great to be able to see this. Some of you might think, this is a lot of information. How am I going to absorb it? It's just like anything. You can't. We learned an entire language when we were 2 years old. You have the capacity to do it. You just gotta start at the beginning and work your way into it, and you'll be able to see it without even knowing that you see it. You'll get into the reaction, the reacting diligently phrase that I use. And I don't care your age or anything else, you're learning now order flow the right way and being able to see it without having to see like a million numbers and be a quant. And it helps to have a bias walking into the qualifier, the trigger. Now, Brad's asking another question. I'm going to answer all your questions, everyone's questions. If you've asked me one and I didn't get to it, I will. But Brad asks a question: is it helpful to watch the footprint to see if they traded or if they were pulled? Yes. Always glance at it. I'd rather see them get pulled. That means there's less people that were able to get out of their longs and sell it, and they still need to get out of it. But either way, you know he was real, and that's how you could tell if he was real, because the footprint is showing you what trades, the dome is showing you what might want to trade. Chris asks, I've often noticed big resting bids and offers at the high or low. Is this indicative of stops? Seems obvious now. No, resting bids can't be stops. Remember, sell stops are below the market, buy stops are above the market. Resting offers can't be stops. They can't be sell stops. They're sells. Resting offers are sell orders, but they cannot be sell stops. You're not going to see buy stops because they're not in the market yet. They don't get thrown in until that price trades. That's the definition of how a stop gets triggered. But the point is that resting offers are not stops. They're not sell stops by its very definition. They're resting sell orders that might want to sell there. Now, you got to build up a story and context going into those big offers, Chris, in order to say, should I lean on it and get short and execute a bearish bias? The closer I get to them, the better my short is, or should I just wait and try to take them out and play this bullish trend I have and look for momentum through there? That's the word story I wanted to get into, and it's coincident it's not the same guy, but Brad is his name, is someone I'm thinking of reaching out to. And if I do, positive he'll contribute like Woj does once in a while, because he's looking to network. He's a 12-year prop guy, and he uses the word, I listened to him talk in an interview, the word story. He builds a story. And I use the word scenario, right? What's your story? It could be a macro story, like it could be like the whole multinational is kind of a macro story. And I really think this index that is tagging what the multinational companies in the U.S. are doing, I think that's the story that's driving the index. So if they really start stepping on the multinationals, I want to be short the ES, and my story is playing out. Then you could take some of these order flow instances and help you execute a better bias. Better location to get short on a bias that was better created based on a relationship is when you could rub your hands together and say, you're a pro. You got it. You're getting it. This is the skill. You're going to trade like crap sometimes. You're going to get in a rut sometimes. And that's why these weekly sessions are important. This is what's creating the community. We're upticking it, not the number of meetings per week, but I'm going to separate guys in groups of 3 or 4. We'll get into that in another meeting. I don't know if that's going to work. I know that if I were one of you guys, I'd want to try it and see if I fit and like the guys I was talking to. And you just want to, I want guys to become more and more proficient at this stuff and then throw you guys into small groups. But I don't want the workload for me to go up to, I'm not babysitting the groups. And if guys do it, great. If they don't, great. But I could, the only thing I could do is kind of, in my best judgment of knowing you guys, put you guys into groups that would have a better chance of clicking. You know, I'll put Carl in a group of one just by himself. So this is an instance. Let's, you know what? Let's show another one. Why screw around? Let's show another one. All right. All right. So where is this at? Oh, here's a good one. All right, hold on. All right, let's stop this thing. It was running as I was playing it. We're looking at the offers. Real quick, your customer is going to ask what's going on, what makes sense upside. Let me blow this up again. What makes sense upside? And you guys are going to put in, you don't have to, the stacked offers is what Brad says, starts at 76 half with 1400. Okay? Building context coming in. It looks like this market has come up here a couple times, and this is another rotation that let's watch what happens. What's cool is when you guys play this over, you're going to hear me talk when it was actually happening. See, I have to stop it again. One of the weaknesses of the trading room, it's not a weakness of the room, it's a weakness for those trying to learn, is it goes too fast for them. Well, it's going too fast for them because I'm talking and thinking out loud, and they don't understand or see what they're supposed to be saying. And the only way to be able to replicate that skill is to have recording, drills that you could keep playing back to know what it looks like. All right, I'm going to play it again. So the market's 75 bid, right? At 76 even. That's the bid offer. 3/4 at even, 400 by 100. Goes bid for about 300 or 400. What's funny, I have to stop again, is I'm thinking just the same way I was thinking when it was real time, and then I just said what I was thinking. So you got to watch it, and you got to just look at thinking like, it's obviously easy for me to think like I think, but you got to think like people who know what they're talking about, and think like, well, they're saying the same thing. So in this voiceover, what's cool is that I'm talking about what other markets are doing. All right, let me play it. Yes, and this is like the third time up here. So the story you're building is, yeah, it's going to be, and I'm saying this, it's going to be a little hard to go through here, but let's watch. And I don't know if I did anything here, but let's watch and see what happened. And I want to listen to what I say. I probably don't want to get short because it's like the third test up here. So I don't want to lean on it. But I know other guys are leaning. Now remember, we were talking about longs leaning, right? This is shorts leaning on a resting offer. Shorts are buyers when they try to get out. Oil, I'm talking in the voiceovers, bullish and starting to rally. Oh, and George, are you here today? So I say in the voiceover, should I sell it and get short and use these offers as a lean? And I said, not with the context of what's going on, not with what the NASDAQ's doing, what crude oil's doing, how many times we were up here. And then George chimes in, and George is here today, and says, George chimes in and says, and the Delta bar is minus 2,100. We're at the high of the day. So even though you don't want to get short and lean on these guys, you have to realize that other people are. Remember what I keep saying? There's always open short position and open long positions at every moment and every day, no matter what time it is, no matter where we're at on the chart, where we're at on the dome. So those who are short are leaning on this, and they're not, the orders are not trading, they're actually getting pulled. Let me back it up a few clicks here. Like, so this is like 1400. Right here where my cursor is, 1437, offered at 76. As I move it, I'm going to slide it on the slider up a little bit. They're pulling orders. They're pulling orders. Now it's just 1100, but only 100 traded. Right? You could see them kind of yanking orders, even though they're only trading, if you look at the footprint where my cursor is, $1.20 traded. There was 1,400. Now there's only 1,000. George mentions we're at minus 2,100 on the Delta bar. We're at the high of the day, and I'm saying, look at all the 1,000 lot offers. It's making it tough to go through. And I reiterate, not with the context. Should I sell and get short? Not with the context of what George is saying, what oil's doing, what NASDAQ's doing, and how many attempts we've had up here. Let's keep watching. Keep watching. Just keep your eye on the red. All the offers stacked. There's 980,000 above that, 990 above that, 1193 above that, 1119 above that in the book. $800 left. 280 have traded. They refreshed some. There. Here. Oh, this is pretty neat. All right. So right in here, it's hard to see on this because it happens pretty quick. But I'm noticing that these offers are getting a little thinner, right? And they just come in and lift 76.5 and flash to 77.25. They just took them out. And the video ends, but I was finishing off on my voiceover talking through this, that I had seen that the offers that were stacked above were starting to thin out. But you start stacking your story, you start stacking your probabilities. And remember, knowing what not to do is your first step in knowing what to do. Knowing what not to do is often more important than knowing what to do. And it's the context. It's not every order, not every move, not every attempt is the same. That's when you start stripping randomness out. And it's everybody's a common weakness of trading is, why doesn't everything work the same like it does when an LVN is supporting this line? You just trade this line, that line. And it's because you never, ever tell yourself the story. You never build a case. You got to build a case. Here's another thing, that context. Look at my cursor, because I can't draw on this. Look at my cursor right down here. This is a move out of nowhere. And what do we get when we talk about this real time? You usually get people to say, anybody short in here is stuck. it's hard for the market to come right back down. You can look at all this red, that cursor, or not that cursor, that red, that red, that red, these reds. That's where the sellers, tempo-wise, been trying to defend it. As soon as it got above here and pushed north, you had the shorts with grapefruit eyes. And they're leaning on these big orders, and now they're getting taken out after so many attempts out there. Markets goes to the orders because everybody was trying to keep short, and they're the buyers that make it go back to the orders. All right, let's watch. Should we watch another video? Let's watch another video. This will play into Jack's question here. What do we see here? Just give me the price on the downside of what you see. The price that you see something, all right? Pretty simple. You guys are going to say, oh, wait. I'm not playing the screen. So you probably don't see nothing. All right. Now you guys should see something. What do you see on the downside? So for the bid, on the bid side, the price or two that you see that you would tell your customer there's something going on there. Right. Even or 0.1 quarter, 0.1 even. These two guys in here, right there. So let's play it. Let's see what happens. Just keep watching. What's cool about when you guys are going to be able to play this on your own is you could take this slider and run it back and forth. But it's hard for me to do that with this screen share because it sticks. Now they're trading these 1 quarters and they're pulling them. Boom. Take a look at this. This is what you got to replay and replay. I just backed it up a few steps. Oop, let me back it up a few more. Let me trade it. All right, so they offer 1/2s for about 300 or 400. And when as soon as they do that, what happens? Let's rewind it. Right now it's 1/2 bid. So if you're a good quoter, you know it's 1/2 bid for 237. There's 572 offered at 0.175. These are the two bids we're watching. As soon as this bid goes from bid to offer, which means contracts will show up in the red, then it's 1/2 offer. Watch what happens to this 1136 number. In fact, don't even look at anything else. Just look at this 1136 number here. Boom. I'm trying to stop it. A lot of it gets pulled. Only a couple hundred trade, but there was 1,100 there. Now there's only 500. What the heck is going on, right? So then that price goes offer, and it goes offer, and I stopped it for almost 500. And they immediately start to trade this number, 1 quarter. And they just only traded 400 and they take it offer. They're pulling the bids and not even hitting it. So the guys leaning on that stuff are selling or trying to sell it, and they're probably stuck long. In this recording, I was long, and I had made money on a portion of my position, but I still had a third on, and I used this to get the heck out and not take any more heat on the last third. Not that there's any more heat because I made money on the trade, but not take the last third against me. And George says at the same time the bond started popping back up. Let me play it again. He's saying it got a little too heavy, a little too long, pulling the bids. Look at him wash this thing out. It goes 1/2 offer, 1/4 offer, 1 even offer, 0.75 offer, even halves trade. Now there's a couple big bids at 1/4 half. He's doing the same thing at even quarter. I'm trying to speed this up a little bit. Same thing happened at even quarter, even. And I say this in the voiceover. Look, he's bidding even half for 1,100, 1,200. He's bidding even quarter for 1,200. The guy's doing the same thing. It goes down there and half of them are gone. It goes offered, they pull 400 and only 700 trade. Pulled it is what I say in the voiceover and what I'm saying now. I was small long. It was an opportunity, I say in the voiceover, to get short if you're bearish or get the heck out of your longs at a better price at 1/4 instead of taking 5 more ticks of heat. I don't think this thing goes, the recording doesn't go much further. So I think we watched four videos today. Let's see. 1, 2, 3, 4, 5 videos today. And I'll post those by tomorrow along with the recording of this webinar. So you guys, if you make it a priority, we'll go over and over and over and over and over it again. All right, Jack. But real quick, before you go, Jack, does that answer your question? There's value in it getting pulled. There's value in it getting traded. And you just got to remember the concept of what are people thinking when they see it and they're leaning on it. The spoofing is something that it's kind of spoofing one, but that has gotten cleaned up with that CME Rule 575 about 8 months ago. Has it absolutely eliminated spoofing? No. It has curtailed it, though. And the book is easier to read than it was a year ago. That's one of the things in the white papers I'm writing is the changes in this business that are for the good. The changes within the changes of electronic trading. That's one element of it. So let me go back through and not only answer some questions you guys have since I've been going over this, but also questions you guys might have from last week, from 2 weeks ago, or about anything with the course. Even George agrees it's changed and gotten a little easier to read. No, so Zane's asking me, is the VWAPs go up? Is that a clue as well? Don't look too deep into that. You know, VWAPs going up is indicative of maybe a trend staying intact. RJ, what do you mean? Well, I'm gonna send you a chat. I'm not going to stop. I was thinking of stopping the recording during the Q&A session, but I'm going to let it roll. So if you guys, this is pretty much the end of the session. I'll roll into Q&A. If you want to listen to some questions, I'll repeat them. If not, this is essentially the end of this week's session. RJ, I just sent you a message answering your question, so take a look at that. So Michael B asks, aren't they limit orders? I think that's in the context of resting orders are limit orders. Yes. Yeah, I'm going to continue. The recording is still going on with the Q&A. So I think I answered this, but what is the significance between the orders that are pulled or whether they're traded? If I'm leaning on the order and it's pulled and I'm still long, so if I'm leaning on a bid and I'm long and he pulls it, I'm probably in more trouble because there was less people that had the opportunity to get out of their long trade and they still have to get out of it. So pulling it typically will get a market to follow through down if they're pulling resting bids faster because it's that, the floor falls out from underneath you. You go down faster. RJ, where are you at? Where are you from? From the US? All right, good. So Michael's asking, the question isn't whether spoofing is effective, but if it's ethical. Well, right now it's against the rules, but spoofing used to have more of a presence until that rule came into effect. Spoofing was guys putting in orders and taking them out really fast or being able to take them out fast, and it was games that they were playing. They were actually not just trying to trick us that are trading and watching it manually, but other algos and other automated systems to get them to do this or do that. And if the intent isn't to fill, then you're just chewing up resources. The best way to explain why spoofing doesn't have a place is that when everything was traded in a pit, a broker wouldn't say 2 bid for 1,000, I'm out, 2 bid for 1,000, I'm out, 2 bid for 1,000, I'm out. They'd string them up and throw them in the river outside the exchange. It wouldn't happen. Ken says he never liked homework, but this must be the best homework he's ever done. Good way to put it, Ken. Thanks. All right, Jack. Thank you. And Michael Lewis is the guy who wrote the book. It's probably Dave, you read the book, right? Would you recommend it for others to read? I think that Flash Boys, it's more, yeah, Dave would recommend you guys read it. I kind of know the logistics of it, and I have trouble finishing a book, so I might just read the first 20%. In my opinion, most books, that's why the Edge course, the chapters are shorter and the videos are shorter, because in my opinion, most books, all the content is the first 20%, and the next 80% is just repeating the first 20% to make them 300 pages and make them the size of a book. I think that's what most books are. It's a lot of, even if it's a good book, it's just a lot of back-end fluff for the first 20%. Anyhow, Flash Boys is the name of the book. Michael Lewis is the author, the same guy that's written a lot of these good books, but he was kind of, he's not a cavalier, he's not a crusader for high-frequency trading is more or less the subject of how a lot of companies have automated being able to see other big buy or sell orders as they're going into the market, race them and front run them. Front running is and always has been illegal. And they found a way to do it because how the NYSE is set up. And it's kind of like borderline, is it unethical, legal? The way they're doing it seems like it's just kind of ingenious, but it's not, wasn't just and isn't just affecting stocks, but any market, including futures. And that book cast a big spotlight on HFTs, as they're called, and many of the regulatory agencies, the Department of Justice, the SEC, the CFTC, opened investigations on a lot of it on all sides of trading. That rule came out, and I don't think it's a coincidence that the CME worked on and early this year, for the first time in over 15 years of being a publicly traded company, started educating the industry on futures. They never did it, and I think they anticipated less volume that they'll be getting from HFTs, and they need to fill that vacuum, which is great. Bring in the retail customers and let them tee up their accounts for people like us. One of the things that I've included in this white paper of the transition of this business over the last several months, and I think it should be exciting to be in it and be a part of it. The Flash Boys approach, Dave says, requires multiple exchanges executing the same markets. And while I realize the CME doesn't have that problem or feature, they could front-run orders from different ancillary markets. They could use the high frequency to race a big order in one market in the S&P, or be able to pull their orders and here's the other thing that high frequency stuff does. It's not just the front running from the multiple exchanges like that book was about, but it's what called latency loopholes, where some information might be given to certain firms as to orders going in. So while it's not a multiple exchange situation, they self-create one. That's another guy I got on the calendar is Kepler, and I'm going to have him talk in front of this group um, about just using Profile to create a bias and then using our stuff here to execute it. I think they're pulling those, walking those data arrangements back, though, Dave. Name of the book, I think I just told you guys that, Bob. I reread your question. All right, Luis. Glad you liked it. Carl. Um, have I decided about the small groups when to start? No, but soon. I got to sit back and look at everyone and then break them into groups and then walk it out like that. Brad, I think so. Brad asks a good question. All right, Joe, glad you liked it. Did or do floor traders still lean on the bids or offers? And if they do, how did they tell at what price the large size resting limit orders are located? Because the broker would yell it, 3 bid 1,000, 3 bid 1,000, and the market might trade some and then move away from it. When it came back down, the guy would yell it. All right, Dave. Appreciate that. Dave's working on testing a couple chat options that would make it easier for these small groups to communicate. Hold on a second, guys. How do you know for certain large bid order is not going to get pulled? We covered that. Do I still have to? Yes, Bob, you do. Hey, email me that link, would you, Carl? So this is a good question, Bob. Is there relevance between the normal size of the day versus the size of the larger order? It could. I mean, what's more important to think about relative to Bob's question is, you know, if you looked at some of the earlier images that you guys might have seen on the Edge course, there were 1,000 lots up and down the book. You don't see that anymore, do you? So some lighter vol, it's funny because when the market's tight and not moving, the volume in the book is thicker. And you think, well, must be more volume trading. No, it's just nothing's going on. And if a market isn't moving around a lot, it's less risky. If it's less risky, more people trade, put more size on. More people have bigger guts, right, when it's less risky. So there's more bids at the bid, more on the offer. And when it's really moving around, there's lighter size on the bid and offer. But yet the overall volume is more. So anytime you hear the pundits, business channels say, well, the market really sold off today because there was lighter volume. No. It sold off today because there was a catalyst, probably a news event or something, not because there was no buyers to hold it. If there was no buyers to hold it up, there probably equally, by that logic, there's no sellers to sell it down. If there's no volume, there's no volume. That's not why markets move. There's no volume. It's because if you ever notice, the bigger moves have more volume in it. More people are playing. More people are trading. And when they say market went down because it was a light holiday schedule or whatever, there's no logic to that. There's none. So you got to keep it relevant or relative to that period. What's a big order? That's good. Yeah, Carl. Thank you. RJ, you got my reply, correct? I'm just going through some of these. Spoof at the lows. All right, that's good. That's good. That's good. RJ's all set. Tom, are you still here? This is good. So Tom says straight profile seems bad because even a daily profile VPOC, volume point of control, may be showing peak volume that occurred an hour or two, therefore would be more dynamic, such as 20 to 30 minutes would be more valuable. Question mark. That's why you can't just, that's why it's like deceiving because, it's great when it works, but it's inconsistent and there's too much room for error with straight volume profile analysis. So it's good as like another, well, there's some big volume there, but is the volume still long or short? It's just an accumulation of straight volume. You got to understand stuck positions, open positions, and then you'll understand market direction better. And then you're using these little skills to execute. If I started your people's education from this, it'd be difficult to like, oh man, what am I going to do? But it's still early on in the whole course. I'm not doing this a year from now. It's early on in the course. This is the same way, not that I would do it. This is the way a prop firm rolls out education. Early days in my prop firm, there wasn't necessarily structured education early days, but a lot of us already knew order flow, market relationships, and we would talk about it all the time in an unstructured way. And I remember the owner of the company say, I take for granted for these newer guys that might come in, not from the floor, not knowing training, that order flow is important. We take advantage of knowing it. And what is it? And we'd have a discussion about what it was and things like that. But everybody in that firm, everybody knew how to quote the market. They knew bids going offered going bid. Then the guys that were hired that were not from the floor weren't necessarily given this exercise. That's something I uniquely created, but they were told in their early meetings in education what all it meant, bids going offered, offers going bids, and stuff and such. So let me wrap it up there. It's been about an hour and a half. I like to keep these between 60 and 90 minutes. Just more content, exercises, and drills. We know what's on the schedule tomorrow for you guys that are in the room. We'll talk about how today and overnight into tomorrow early session, how that's setting up for tomorrow's FOMC meeting. Next week, Woj is coming, and the week after, unless George can't do it, we tentatively will have George talk about the Delta Bar, his Delta Bar stuff, which could help create a bias and use this stuff to execute it. So have a safe week, night, and we'll see you guys either next week or tomorrow morning in the room. Carl, get the flies off your monitor. You'll be able to read your dome so much easier.